let Dean explain our offerings to new trials, and then jump in for the rest of the hour before our boot camp and really dig into the details.
You are live.
Okay, great. All right, guys. Well, today is April 23rd, and today's trade alert, we have a small change to the portfolio, and that's just to roll over your TLT put. So we are closing out the 62 strike 424 TLT put and buying the May 1st. So that's the only change if you are an existing member who already has the full portfolio built. Now, if you're new, you have a great opportunity to build our full strategy out today. And here's how we have assets allocated per $75,000. So the way I make this super easy is for new members onboarding, I mark if it's a buy and hold or if it's a hold and do not buy. So I do want to note that I am putting a hold, do not buy on GDX. So we've seen this really fly up, and I'll be tempted to purchase another put for those of you who already have that 28 put, but I am waiting a bit. And you will see that I am recommending for new members to pick up your GDX put, but to potentially wait to pick up those shares. Now in buy and hold, there's no changes. We had some reverse splits, so I'll update the buy and hold track record to reflect that, but you have no change. So the cost of your shares rose in value, but they reduced the number of shares. So net, no difference when they do something like that. So let's look at how we're positioned for what we're seeing as a once in a lifetime opportunity. And I'll go through all the details of why I think these market predictions will play out. But simply put, we're expecting a huge rally in the US Treasury market and a massive stock market crash in the SP 500, also in the Chinese market as well. So we'll look at all the trades. In terms of gold, it's extremely correlated to stocks as well as inflationary forces. So I do think that all the hype about buying gold is a bit early, and I'll explain our strategy to take advantage of that, to get in early, and where I see the transition from gold miners into spot silver to play something like we saw during the 2009-2012 run-up, where many people became very wealthy from that shot up in silver as well as gold. Okay, so if you're a new member and you're just getting started, everything's based on a lot of $75,000. Many of our members are following the system with multiple millions of dollars. Some have less, some have more. It's all designed around a lot of 75,000. So if you want to get started today with 75,000, this is exactly what we would recommend you do. If you wanted to do it with 150,000, multiply everything by 2. Okay, so the single most important position to put on immediately is the TLT ETF. For every 75,000 invested, we have 200 shares of the TLT, and that plays the 30-year treasury. This is by far my favorite position and is a buy and hold recommendation likely for the next 2 to 5 years. And we'll talk about why, targets, but I think it can at least double, if not triple, based on the massive growth of debt the world is accumulating right now. So far, the US government's already promised $2.6 trillion while giving everybody tax holidays and letting everybody just sit at home and get paid to do nothing. So that's a pretty easy calculation and is by far my favorite trade alert for investors at this moment in time. And we'll again deep dive into the analysis of that. Japan came out and said they're going to do unlimited QE right at the market open this morning. ECB is going to do more junk bond purchases, but it's all just a desperate guise to try to keep the market alive for a little bit longer. Meanwhile, the Fed's quantitative easing is coming to a halt abruptly, and so we'll take a look at that data later too. So because of this, I am skeptical for investors to buy GDX today at what I believe is a recent high, at least, not the all-time high, clearly. But what I will endorse is picking up your put option so you can safely buy those GDX shares in the future. So currently, we are not recommending to pick up your GDX shares today, but I'm also not telling anyone to sell them because we're up and we can protect that with a put. And you already have a put. So we've paid off both of our puts and have done quite well with GDX. Again, the problem is it's extremely correlated to inflationary pressures. What's coming our way is deflationary, not inflationary. So I do think gold investors have been fooled thinking that the simple fact that there's quantitative easing happening or the devaluation of currencies is the only thing you need to hit a win on gold miners. So we'll take a look at that. My favorite trade for a short-term big profit that I believe could pay off relatively soon is playing the USO, United States Oil ETF, which has been collapsing and is really a great risk to reward ratio when you use the married put strategy. So we'll cover that. This trade has some good news coming in. Mainly Saudi Arabia is just flooding world markets with oil. They've got 50 million barrels headed our way, even more to Asia, which is good because for USO to go up, we actually want the long-term expectation of oil to crash and then have a sudden surprise for the short-term price to jump. And so we'll talk about what could create a short-term jump in oil prices on the front month and what Saudi Arabia is doing that's really crushing long-term outlook. So let's continue into the trade alert. The next part of your portfolio positioning is one that you have to be patient for, but I think this is the single trade you put on this year, sit back and make the best return you've made in your lifetime. And we'll take a look at the mechanics of what's going to take the stock market down despite every central bank trying to throw money at it. But this is the set of put options I do endorse at this moment in time to buy and hold that will profit if the SPY ETF, the S&P 500, does crash. So these serve two purposes. Not only can they generate large profits, there's a set of ETFs we want to rotate into after no less than a 50% correction in the S&P 500. And that could be not even enough. So we'll talk about what our exact intentions are with these timing and what we're going to roll into. But the analogy I like to use is we're building a house with your trading portfolio. The bond market is the roof. The floor is your SPY puts, so that's your foundation. The plumbing and electricity are really your gold and oil plays. And so we'll talk about how these all connect together. But beyond just owning these ETFs and purchasing this set of put options, we also have a set of options for the other ETFs you do hold that I do want to cover. So the strategy that's allowed us to have extremely low drawdown is one in which we is one in which where we constantly have put options protecting every single asset. So think about it. You don't drive a car without car insurance. You don't go to the hospital without health insurance. So why would you have your nest egg not having downside protection? So our portfolio has had these extremely low drawdowns because we constantly pay for downside protection. Most of the time, the downside protection does nothing. It expires worthless. But every so often, when there's an unexpected crash in the market, in whichever ETF we're holding, these put options can really serve a huge benefit. And we've had 1,000% returns on our downside protection, which has removed volatility from our account. Now, the downside to having constant insurance is it does act as a drag on our returns. So that does mean that we have to not only get the direction right, we also have to pay off our insurance to derive profits. So that's the really the benefit and the downside to having such a safe strategy at all times. So currently, for every 100 shares of the TLT, we're also endorsing owning two May 1st 162 TLT put options. Then to add extra leverage to our favorite play, we have this set of TLT call options, still a buy and hold. So these are 3 positions which are all up quite handsomely, but are still a good buy at today's prices. So if you've missed this trade, you can still put this on today. And again, this is the only change for existing members is we've sold the TLT 162 put from expiration of 4/24 and rolled it into the next week. So if we believe that the asset can appreciate quickly, we want to buy the cheap put and roll it over weekly. On the other hand, if we're expecting a big move for a longer period of time, I'll buy a more expensive put option that's near the money or in the money with a lot more time premium. Okay, so for GDX, we currently have 2 put options open, a 23 strike expiring May 15th and a 28 strike expiring 8/21. I'm not issuing a sell alert on the 23 strike GDX at this point in time. It makes no sense. It's worth very little. If we do get a correction sooner than later, we will sell both of our puts. If you're new, though, I do endorse picking up this 28 GDX put today, as it will provide the insurance you want to eventually rotate into GDX. So we're currently not endorsing buying those shares right this very moment. If you already have them, don't worry. You've already got these 2 puts and are up considerably on the position. Okay, the next trade that we have that's very exciting is, again, that USO trade alert. So this is protected with a married put. So currently USO is trading at 277, and we're endorsing to buy 2,000 shares of USO, protected by your $2.50 January 15, 2021 250 strike USO put. So it's called the married put, and essentially you want to pay off the cost of the put when you end up selling your USO shares to derive a profit. If USO goes to 0, well, it's not a big deal. You bought your insurance and you get $2.50 a share. Now, the reality is I don't think USO will go to 0. And if it does go below $1, I will be very incentivized to sell that put and remain long our shares. So that may not happen. The bottom may already be in, but this is something that can also derive a profit, is that we sell the put for a big profit and then remain long our shares. So those are the 2 options I see playing out for USO. And we'll take a look at the details of that in a moment. We have a emerging market play that's expiring May 15th. That's a hold, don't buy. I'll be looking for a period to sell that in the next several weeks. The new trade that is available today is to short China directly. So we started off shorting emerging markets, which has a large exposure to China, but it's not completely laser focused in on China. So I am expecting geopolitical tensions between US and China, which will involve financial sanctions, restrictions of capital flow to ETFs that are essentially funneling money into China, into companies that have no obligation to be audited by American auditing firms. So this gives China a huge advantage against US companies, and is a pretty easy violation that could be used to start restricting that capital flow. Also, we're seeing the social unrest in Hong Kong, their financial center, continue to weaken, which could be another method that the US does attack China, is to start picking on Hong Kong, their financial center. So because of all that, this put option on FXI has tremendous value. I don't see the S&P 500 going to zero, obviously, but the U.S. controls the FXI product, which is just an ETF that buys ADR receipts. And so while we don't think China's stock market will go to zero, the ETF certainly could. If that is the case, you're paying about $1 for your put and would walk away with $31 if it were sent to zero. So that's a potential 30-to-1 return, and one of my favorite trades headed into the election, which is almost certainly going to be focusing on all the pain Americans are suffering with record unemployment due to China not alerting the world of just how dangerous this was, and potentially being able to prove that they took measures to let it spread rapidly and at the same time monopolize resources that are required to treat it, which seems to be quite clear at this point. So currently we have less than 85% of our capital allocated and at least 15% in cash. You should expect to sell your TLT calls, SPY puts, USO puts, GDX puts, FXI puts, and emerging market puts between May and September to free up capital to rotate into the 5 target ETFs, which I believe will outperform their peers. So many companies are just not going to be back to normal this year. Specifically, anything that involves a large gathering. So many parts of the S&P 500 are going to be kept on life support while really punishing the overall index. So that's why after we do get the big correction, I don't want to buy the S&P 500 right out the gate. I think we can make much more money looking at where the government is going to subsidize and provide this $2.6 trillion in current promises of stimulus. And so I think the biggest beneficiaries are pretty dead obvious, and that's healthcare, XLV, biotech, which I like the most considering the world desperately needs this set of vaccines, IBB. Medical devices, we're nowhere near having enough of the equipment we need to deal with the current crisis, IHI. E-commerce obviously is going to have incredible growth relative to its peers, and this is really sad to see. Retail just, they were already getting crushed, but with this, Amazon is just going to really punish its competitors and be able to expand its real estate space for more and more warehouses. And then finally, Boeing's the big player in ITA, but there's also Lockheed Martin and a lot of different military-related stocks in this ITA. So we've seen the military budget grows like clockwork, certainly has a strong grip on the government, as well as obviously your big banks. So these are the dead obvious companies that will really benefit going into 2021 after there's been a major repricing and valuation of equities in general. So that's this is what my intentions are to get us into after we've had a serious correction. And we'll take a look at how to enter these positions, but it's going to start off by selling a put that will in itself be highly profitable and give us some cushion getting into these positions when the rest of the market is absolutely frightened, because the stock market will be falling off a cliff, and these are the ETFs we want to have the confidence to get into. To help you have that confidence, we have this set of put options which will allow us to jump into that position safely. So that's the big overview of our strategy and how we're currently positioned. Our strategy is currently up 3% this year. We've had as much of a return as 15%, but the Bank of Japan primarily tanked the TLT, the bond market, to try to protect its equity positions. And so that gave us a little drawdown and took away some of our profit, but overall, beautiful return. We saw the stock crash way before it occurred and understand that this is just the tip of the iceberg. So we've been warning investors, positioning, and I think we're going to have some of the best returns in this service probably for the next decade, just because of these huge moves that are occurring in the market. Okay, let's take a quick look at some questions, but I do have a lot of other content to go through here. Ali says, what happens if USO splits? So yeah, they are splitting. So they're going to take every 8 shares you had and give you 1 share, but that won't change your position at all in terms of profit or loss. Murray says, should we still hold the 23 put? Yep, hold that 23 put. We'll look for a better day to sell it. Ali says, what's the best place to learn about options? Well, our boot camp has 4 hours of content that is a great starting point. But I would say it's medium level, so I can also get you some more basic tutorials, but we are planning some super basic beginner level options modules in our boot camp as well. Murray says he just got his Forex approval. Took 2 weeks. I'm going to do the Hong Kong trade. Great. Well, let's cover that in the boot camp, which is coming up right after this webinar. So Murray wants to short the Hong Kong dollar from our boot camp trade, and that is a potential 100-to-1 return. So if you like the FXI trade, this one's much better because it's almost impossible to go against you, whereas FXI can obviously be manipulated by central banks. Steve says this market is stupid, inflated. The real Dow is going to tank 14,000. Okay, great. If you guys have more questions, please keep them coming in. I do want to get a quick overview of everything I have. Then we'll take a break at the 1 hour mark to review our programs for all new trials, and then also continue all the way till our boot camp. So we're going to take only a 5-minute break. So you can expect this webinar to run a course of 2 hours. We'll take a 5-minute break and then jump right into our boot camp presentation. Ram asks if we need the Forex account. For the boot camp Hong Kong trade, you should use TD Ameritrade's Thinkorswim phone app to be able to short the Hong Kong dollar. You need to understand exactly the strategy behind that. But that's the trade that has extremely little risk to lose money. And if Hong Kong's peg breaks, you make up to 100-to-1 return. Sunny says, do you cover Bitcoin option strategies with the halving coming up in early May? I'm liking your macro analysis and equity bond strategies. Yeah, so I have orders personally. I've made a ton of money in that space, Sunny. So I've done extremely well with that. I wouldn't be buying Bitcoin ahead of the halving right now because of its strong correlation to the stock market. And what's happening in the bond market is going to absolutely crush stocks once they actually start trying to sell this to the public instead of just printing money and sliding it to the government right now, which is what they've done so far. So we really haven't seen the pressure from the bond market put onto the real market yet. And that's what's probably coming in the first week of May. So my targets are to pick it up at 3,900 for BTC, but that might be too high. When we look at the magnitude of what's happening and how far stocks could crash, I wouldn't be surprised if Bitcoin could go significantly lower than 4,000. So I know that's not what Bitcoin maximal fans want to hear right now. And I know that's not been the price movement we've seen in Bitcoin or Ethereum. But I'll show you with almost undoubtable proof it is extremely correlated to stocks. And I can show you the evidence that the stock market is really on life support and coming to an end. So we'll cover that in a moment. All right, let me hop through a few more things. We'll get to the 1 hour mark. Dean can do a review of our programs, and then we can continue onward. If you do have a question, please use the chat box for right now, just because we have a lot to get through. So quick review. We believe that stock market is on life support. There's a few headwinds that could keep it up for a few more weeks. We'll take a look at those. One of which I believe will be the administration fixing the US oil problem, which we are positioned for beautifully. We can actually hit our target 15% yearly return just from that play, maybe half of it on a modest jump. On a big jump, we could actually hit our 15% year return just from that single trade. So I really like that trade and believe that will be one of our best returns in the very short order. So this is a big problem that's developing quickly with the USO, and I do think they have to solve it quickly. So that's actually one bullish move for the stock market. But let's go from head to toe. I'm going to start off with some news today. And Karen says, I've been watching XLV, IBB. Yeah, I'm sure you've been watching Amazon. Do you think there will be a pullback on them too? And is that why you've not established a position yet? Yeah, I think at least a 50% sell off at a minimum, which is hard to believe when you watch the stock market rally. But don't forget, in February, we were at all-time highs. Then we went on the most vicious crash in history. Unemployment is at depressionary levels. And the root cause of all this turmoil is nowhere near being resolved. Okay, so let's see what we want to look at first. So I'm going to start off looking at the major stock indexes. So this is credit to Jeffrey Gundlach has been showing this. And the point of this is that it seems that stock markets tend to get overvalued and then suffer for decades to come. And then a new market becomes the big hype. So who remembers when Japan was the big hype? So we can see the Nikkei in yellow. Great story to study what happened to Japan. I believe something very similar is happening to Hong Kong, which is of course a part of China. So that's why we have obviously the short positions on FXI and on the Hong Kong dollar. So we have a potential 100-to-1 return and 30-to-1 return on those two positions. And we're risking about 1% of our portfolio. So if I'm wrong on the FXI position, you lose 1%. But if it gets knocked off the map by the US government, then you could have a 30% total return from risking 1% of your portfolio. So it's a beautiful trade. If they don't go to that extent this year, but it just sells off with the overall market, we can still get potentially a 5-to-1, 10-to-1 return on that FXI. Here's Japan. What happened to Japan? Their manufacturing sector was taking off in the 80s. Tokyo was valued at more than California. It was going to overtake America. Absolutely ludicrous. Real estate prices went sky high. Government took advantage of that, started issuing massive debt. Cost of labor rose, and guess what happened? Corporations got the hell out of there and went to China. And so the same thing's happening in Hong Kong right now, by the way. But what had happened to Japan's stock market? Well, they were faced with a crisis, and that crisis was one in which they had to choose which asset to protect. Were they going to protect their stock market? They chose not. They let the stock market crash, the real estate market crash, and it's never recovered. So 3 lost decades, 30 years later, it's still not back to where it was in 1989. What did they choose to protect? Well, they didn't have an expansionary view like China does. And what they ended up protecting was their currency and their bond market. And to this day, they still protect that as their core asset. So we can look at the yellow line and see that if I zoom out a little bit, you can see that that's what happened when they chose to blow out debt. And it's just been a very dismal return for Japanese stocks for 3 decades now. Also, the Bank of Japan happens to own something like 2/3 of their entire stock market. So what I believe will end up stopping the US stock market from crashing will be something similar to what Japan has done, which is to nationalize your stock market. But that doesn't mean it will go up. It just means it can flatline. Okay, so let's go a little bit further in history and see what happened next. So we come up to the dot-com bubble, which we all know was really nice for US stocks until it wasn't. So the Dow's in black, but what's in purple is the European index. So we saw the creation of the euro dollar, And this was supposed to be the new big thing. Their market outperformed everyone substantially in the dot-com crash, and then since then has been crushed. And so they've been trying to deal with it with negative interest rates, which has put companies like Deutsche Bank nearly out of business, and really just proven that this debt negative rate model doesn't work in the long run. Okay, so we go another decade into the future. We go to the 2008 crisis, and who's the best returner there? We have emerging markets and the Shanghai Composite in turquoise, or I guess that's, what is that, cyan, and pink. So they outperformed the US market by multiple factors. But then what did they do for the next decade? They underperformed US markets. So here we come to the most recent bull market. And surprisingly, at least in this rally, the Japanese market has been keeping up, the only market keeping up, but it's really the SP 500 that's really shown. And if you go to the QQQ, that really shows what US's biggest advantage is, and that's all our technology companies. So Jeffrey Gundlach believes that the measures we're taking by expanding the debt of America, the corporate debt, the public debt, is going to punish stock returns for at least a decade to come. So that's the first exhibit we wanted to take a look at. The next exhibit we have is the TLT. So this is our top pick for probably the next 2 to 5 years. If you think there is going to be better profits for companies in the future, you want to front run that and buy companies. If you think there's going to be an expansion of debt at an accelerating pace by your government, you want to do the opposite, and that's when you want to buy the TLT. So the TLT's had a beautiful run since Paul Volcker left the Federal Reserve and Alan Greenspan came in. So that was right around the same time that Japan's decline began. So what's happened during that time? The government has ballooned their debt like clockwork, but most of the ballooning happens to coincide when there is a financial crisis. And so we can go look in history at the various crises that are at least shown on this chart. So think about that 2008 crisis. What happened? We grew the Fed's balance sheet by trillions of dollars to absorb losses in the real estate market. And you can see the TLT spiked significantly. At the same time, stocks crashed. Okay, we can go to 2015. This wasn't necessarily a crisis in the United States, but this is when China nearly went bankrupt. So they ended up growing their debt to GDP, their internal debt to GDP. So no one wants to lend the Chinese money. So they just print their own currency to do the same effect. It's a closed economy. So a lot of Americans are trying to get their money and companies out of China, and they're just not letting that happen right now. And so that's the case with really every penny stored in China, is it wants to escape, but it's not allowed to. But China went from having 2 cities that you could manufacture to creating the entire country was just overbuilt with skyscrapers. There's at least 12 cities the size of New York in terms of skyscrapers that were abandoned, not completed. Tens of millions of fancy condos they built that were never sold. The average China male who's a candidate for marriage has 3 to 5 houses, none of which are rented out. So it's the biggest housing bubble in history, and they had to grow their debt to GDP from 250 to 350% to survive that. The cost of this was massive inflation for the consumer, and at the same time they're facing massive deflation in their manufacturing sector. So that's the exact combination for a Great Depression. But they were able to print sky high in 2015 and save the market for a period of time. And so that's where we saw the TLT also climb. And again, that was a huge expansion of debt. So 2018, they tried to raise interest rates and vacuum out money from the markets. And we all saw what happened with that. first Bitcoin crashed when that started, went from 20,000 to I forget how low, just extremely low. And this is just from the fear of interest rate hikes. Then we saw emerging markets tank. And then by October, the 10-year treasury was so attractive that it caused money to flow out of the stock market into highly rewarding 10-year treasury notes at 3%. And you got that Christmas massacre. So the Fed came right out with rate cuts, more QE, and the government has been excessively expanding its deficits. And so what do you get? Once again, you get this huge rally in the TLT. Now, right now, at this very moment in time, we've printed $2.2 trillion into the Fed's balance sheet. Other central banks are following suit, not at the same extent. And what happens next is they have to actually sell this into the open treasury market. So the first thing they did was just really print T-bills, which we can see loaded up to the boat right here. These have increased by a magnitude of 400%, as well as the notes. And the Fed has actually been picking up all of this. So you've seen the big rally in the last few weeks. Well, this was because the Fed was growing its balance sheet at the fastest pace in history. Now, the good news for our positions is that they've been dramatically cutting that down at a rate of 30 to 50% week over week. And we'll know Friday as well as this afternoon what their intentions are for next week. But I'll take a look at that in a little bit. But what has to happen is the debt has to actually be sold to real investors, and they want to sell it offshore. So probably end up mostly in Japan, Norway, and big central banks. So when they start to move this debt from short-term debt products in the T-bills out to the long end of the treasury curve, the bonds, that's when we're going to really see the bond market pull resources out of the stock market, out of real estate markets, out of the balance sheets of the central banks and the big primary dealers, and load up that money into what has to be trillions of dollars added to what goes into our TLT product, and that's that 30-year treasury. So that's really what I see coming down the pipeline. Now, what's causing these central banks to freak out and blow out their deficits at the government level and massively devalue their currencies at the central bank level? So as we all know, there's one and only one reason causing all of this. And so I do want to take a look at, is this coming to an end or is it just getting started? And we're looking at the disease that's been spreading around the world. Now, if you do get your audio unmuted later, please don't say the real word for this, as all the big tech companies are now censoring anybody who says anything about this, period. So we have to be very sly about how we write about it. Okay, so here's the metrics I'm using to, and this is also how I was able to predict a market crash when the stock market was rallying to all-time highs. So I was very early to predict this. That's how we were able to completely sidestep the crash. We had a huge gain, but again, the crash was so magnificent that central banks ended up selling their bonds to try to provide some support to the stock market. Because remember, Bank of Norway, Bank of Japan has a huge, massive position in U.S. equities. So that's the bad news. The good news is that this is just getting worse by the moment, and the big crash hasn't happened yet. So our opportunity to make money is better now than ever before, and we're very well positioned, and nothing is going to catch us off guard, because when this first started to happen, I really didn't believe this was really happening. Every day I woke up, this couldn't be real. This could not be real. But every day, this has grown at an exponential rate. So what we're looking at on the right is an exponential log scale of the mortalities, and been tracking this since it first struck, watching what happened in China. It was just absolute insanity. Watch the same thing play out in every other country it's touched, and it's nowhere near an end. So let's take a look at what's going on with the root cause of economic turmoil and what these so-called end of the lockdown and reopening of the economy really looks like. So we really have two models I'm looking at now. So let me just check these out. We have the world and we have the USA. Okay, so the goal is to either get a vaccine, which looks like it's at least a year out. Second thing is we want to get herd immunity. Either one would allow the world to go right back to where we were at in 2019. The only difference would be that every central bank has diluted their currency. So the relative value of stocks after this is all said and done is going to be much higher than it was in 2019 because we've dramatically expanded the level of debt, the level of currency. But the short-term order is that we got to follow the money, and the money is going to be pumped into government bond products. And that's going to start, I believe, in May. We're already seeing it in the T-bills. What we want to see it for our position is it start to load up into the long-term debt. And so I know it seems counterintuitive that an expansion of debt would make a bond product go up, but I'll explain it to you so it's quite clear in a moment. Okay, so we have two models. We need to hit 50% herd immunity, and then this will really be over. So if we think about the flu came about in 1917, and we didn't have herd immunity. We didn't have antibodies, so it just really wreaked havoc on society for a couple years, multiple waves, and there's a lot less, obviously, transportation and connection between society. So that managed to wipe out 50 million people and took several years to work its way through society. But after it did that, it wasn't such a big problem, and the flu still lives with us today, and we don't lock down economies because of the flu. So this likely will be a big problem for us for 2 years, and then we'll have herd immunity and vaccinations, and then we'll put this all behind us. So we're looking at 7.1 billion people who need to hit 50% herd immunity. It looks like even if you get it, only 1 out of 10 will have any symptoms whatsoever. Okay, so this is data that I'm constantly tracking and optimizing. So 9 out of 10 people who do catch it, only 1 out of 10 may actually have an issue. Of the 1 out of 10 who do have an issue, and go to the extent to go get tested, we're finding that 20% of those will need to be hospitalized, primarily with ICU. Now, the ICU, the data is coming out that 9 out of 10 are not surviving. I've cut that down to 80%, so 8 out of 10 do not survive. So this puts my estimate that if society does choose to not have a complete Great Depression, because we don't want to starve the world and we need to get back to work, that the best bet is to take Sweden's model and let it rip through society, or any combination of that, even if it's just a slow reopening, which is what we're doing in the US, slow baby steps towards opening up. So on one hand, you have the president say, oh, it's great, we're going to get right back to work. But then he has Pence and the doctors come up and say, well, hold your horses. It's actually, here's your plan. And quite clearly, it's still not the same as we had before. No, not even close. So to hit our target, to really get this behind us without a vaccine, my data suggests that 56 million would pass away, which is insane because these data points we're updating as the data comes in. And this is actually what Bill Gates had estimated just a year ago in their modeling, which is scary. And we'll take a look at what is Bill Gates really up to here later if we have time as well. Right now we're at 185,000. So that leads me to believe we are 0.33% done with this passing through society. Now we do know the mortality rate is a leading indicator, and that potentially it's tenfold behind. So I take a multiple of 10 and say, okay, well, perhaps with everybody's already had this, which we don't have data on. We do not have the antibody data that's rolling out right now. I'm very on top of following that information. But that would lead me to believe that the world population, 3% at most, have had this so far. And again, that does lead us to believe that the worst is not nearly behind us, despite governments realizing it's not possible to keep everybody locked down for 2 years, and that really you have to let this rip through at some speed. And really, the limit to that speed is just simply what your hospital system can accomplish. So they'll be trying to do everything they can to protect those that are over 75, but the rest of the population is going to have to use the social distancing, masks, all that stuff, and try their best to get back to work and be careful. But that won't work, and the best it could do is really just slow down the spread. So from this, my estimate is that we're nowhere near harming the economy, and that there are quite clearly a lot more pain ahead for the world. Let's look at the US data. So the US data seems to give us a perception that perhaps more people possibly have it here than the rest of the world from the world data. Now, we know a lot of the poorer countries are just simply not testing. And so this count right here could be off by multiple factors. So if we go down to the US data, which is also probably undercounting and not overcounting, as some people like to put out in the media, this would lead me to believe, with the same data based on 48,000 mortalities here in the States, that we've completed no less than 1.7% transmission to the US population. I think the 10 times antibody risk, that's what I call it, because we're using this to predict markets, but I think 10 times is off. But at very most, 17% of the US population has had it. I think that's probably off. I think in the best case for the US, we might believe that there are let me update the spreadsheet. I would believe that the most we could predict for the total US is around a 5%. Now, there is some data showing a group of 300 women in a hospital in New York, 15% had it already. But that's obviously in a high impact epicenter for the US and probably not indicative of the rest of the population. So from this perspective, we can understand that the reason the debt is ballooning at the government level, that the stock market was selling off, that we're having the current turmoil we're in, the root cause of this is just getting started. It's nowhere near getting completed. Okay, so that's very important. If we look at some other data points quickly, we're looking at either the mortality rate or new case rate, depending on which country and what stage they're at. US, we can see the mortality rates starting to flatten, but remember, this is at an exponential rate, and this only happened because of social distancing and lockdown. So if you go start opening back up the economy, this will likely start to rocket right back up. If we go to Italy, same picture. It's starting to slow down, but it really hasn't flatlined, which is what we want. Spain is doing well, extreme lockdowns. Germany is slowing down, but again, they're in a lockdown, and Merkel has essentially said that this is just getting started and is going to be with us till a vaccine. We're just going to have to get back to work. UK, extreme lockdowns after thinking they didn't need to do it, and we're talking about letting it rip through society. Well, after enough death hit, they went to an extreme lockdown. Japan wasn't tracking this, as they wanted to have the Olympics. After it was quite clear they couldn't have the Olympics, they've begun tracking it. And so this is growing at an exponential rate in Japan. Singapore got brave for a little bit and let down their guard. Now, this is confirmed cases, but this is one of the fastest growing exponential growth for a single country out there currently, and they've introduced the most extreme lockdown yet all the way into June. China is obviously not trustworthy, but if they're spewing out negative data, we want to pay attention because they could be doing it for alternative purposes. They went from saying there's 0 new cases for quite some time to suddenly a reemergence right when we're trying to get our labor force back to work. So I don't think that's a coincidence. They're also starting to spew out data that people are becoming reinfected months later, although we have seen South Korea come out with the same data. So that's very bad for hoping that once you've had it once, you're good to go. So that's something that we are also concerned about. South Korea has a phone app, if you get it, that tracks you. If you go out of your house, it starts bleeping at you. Bill Gates wants to have all the world do this, and if you have it and you go near someone, the Bluetooth is going to start beeping at you. They want to have a vaccine that puts a invisible stamp on you, so they can track who's had it or not. So I think Bill Gates wants to create the Netflix business model for reoccurring subscriptions, bill it straight to the government, and get 7 billion people a year using his vaccines. India is showing exponential growth of new cases, but their country's population is so great and the average income so poor, they really just can't test anyone at a significant level. So we're going to see this in all the big poor countries. Indonesia, despite lack of testing and a huge population, it's growing exponentially. Pakistan, same thing. These are all the largest populations. Brazil, growing at rapid pace. And again, these are all on exponential scale. So if they're going up at all, it means it's spreading at an exponential rate. Nigeria, same thing. Okay, that's the wrong chart. Russia having exponential growth of new cases after showing very little cases for quite some time. So interesting, if this was timed, we know that Russia also has been competing in the oil market against the Saudis, which has driven oil to super low prices. And Mexico, same story. So the poorer countries are clearly not doing the testing, but what testing they are doing is showing exponential growth. So the key thing that could change our outlook would be if what's happened is that if this has been around for much longer than we think, and more people have already had it and developed antibodies, that could be a game changer. Now, I don't have anything to make me think that the modeling we have here is off, but that is one piece of news I'm closely watching. And so we know that the antibody tests are just now rolling out, and so we'll keep a close eye for any good news on that front. But bottom line is, if this was I like to use the analogy of a movie. If this was 1 hour long, we've only watched 1.7% of the movie. So we're only a few minutes in, and we're nowhere near to a solution to be able to get people back to work, which is what will really fix the stock market, not stimulus, which again is bullish for bonds and not stocks. Okay, let's take a quick look at some news, and then we'll be coming up on the 1 hour mark to review our programs with Dean, and then we'll go into customer questions there also. I do want to hit some of the topical news before we get into any repetitive content. Okay, Art Berman's a great guy to follow for oil market. The world economy has become financialized. Financial claims exceed physical claims by absurd multiples. That is why the economy is unstable and now collapsing. So he's just completely shocked by negative oil prices. Let's see, I do see some questions coming in. Ali says, is the boot camp recorded? Always. The same video that lets you get into the webinar lets you replay it. I do not have a opinion on TVIX. Pat says, does Bill Gates own a pharma company, or does he have a large position in pharma or on a board of directors? Yeah, he's financed every single company creating vaccines as far as I know. And so there's some good pieces we put out Tuesday, Pat, for the boot camp that really dive into the bottom two videos, really dive into the foundation, what it's been investing in. And this has been going on for multiple decades, so it's nothing new. And also nothing he's been hiding. So he's out really pitching this to the world on Washington Post this morning, for example, where he was really advocating. Dan O'Connell says Remdesivir just reportedly flopped on trials. Odd drop on the Dow. Was there news? Okay, let's continue. Lagarde says to tell EU leaders GDP may fall 15%. Bank of Japan to discuss unlimited bond buying. Now, these are Japanese bonds, but of course, that does add liquidity overall to the markets. To do that, they need to issue more bonds. They already buy all the Japanese bonds. So Japanese government will need to expand its fiscal spending to achieve that. And again, this is all bullish for bond market. It's like steroids for a cancer patient in the stock market. It gives you a little time, but it doesn't solve anything. And what it is fuel for the bond market. Okay, so and this headline came right out at 9:30, right when the stock market opened. Doctors in the epicenter of this is a CNBC reporter in China. Doctors in the epicenter of Wuhan find patients who tested negative later test positive, some up to 70 days later. If you go to the Reddit thread, there's a lot of people who are in their 30s who've been suffering for this for 60 days with no relief. So this could have long-term effects on your health. Okay, Fed is buying junk bonds, unlimited QE. ECB is buying junk bonds and corporate bonds and QE. Bank of Japan discussing unlimited bond buying. Owns virtually all ETFs, zero to negative rates, all of them. Central banks are weaponizing. Mass destruction economic tools, no sense, no limits, no exit strategy. So they've done it for a few weeks, but if we do look at the trend of what the Fed's doing, it's not this. And they are taking QE to an end, which is perfect for what we want. We'll take a look at that in a moment. Kuwait cutting oil output ahead of schedule. For our USO position, part of our prediction is that because the Saudis are continuing to punish oil lower and lower and lower, it's going to cause people to shut off their drills and potentially go bankrupt. And again, that will help with our position dramatically. The other little piece we need is for the administration to come in and buy a bunch of U.S. oil, as well as pay our drillers to take a pause, just like we've done in all the other industries. Pay them to sit on their hands. And that's exactly what we want for USO. So we'll take a look at that in a moment and get a few more news pieces out, and then we'll switch over for Dean to review our programs for everybody on a trial. This guy's just a comedian, but he makes good comments. Hipster, if we continue to lose millions of jobs every week, the stock market will be back at all-time highs in no time. Wall Street celebrates another 4.4 million unemployed. They just did another $500 billion for small business loans. Again, the deal on that is 75% of it has to pay the bills like rent and like your employees, but 25% they can just pocket, which a lot of people are outraged about. But this is helping keep the unemployment numbers low. So even with $500 billion of free money to small business, we still have the fastest growth of unemployment, 10 years of jobs wiped out in 4 weeks, and they're just getting started. Once we realize that restaurant, who's going to go to a restaurant? What's the cost of a meal if you have to dramatically reduce the traffic in your restaurant and you're going to have to wear potentially a mask? I mean, it's complete insanity. So a lot of businesses just won't work until we're not scared that we're going to get sick and from our fellow peers. Kyle Bass, the Saudis are sending us a 50 million barrel oil bomb. Of course, the Saudis are an ally. It looks like they really need to dump this oil. And again, we can see that they are doing this to fight a battle against Russia. So this is actually good for our USO position. I know that would make people think the opposite, but this will, what they're doing, sending oil all over the planet, even more to Asia, is going to depress the long-term outlook of oil prices, which is what we want at the same time that we get a short-term shock. So we'll look at how USO works in a little bit, but this in itself could continue to pressure the stock market and really be the next catalyst. So if this oil problem at the world level is not solved soon, will quite likely continue to be the key driver pushing stocks down. And at the same time, we're going to look at what the Fed's doing. Pork shortages to strike America in 2 weeks. All the people who track the food supply are predicting dramatic increases in prices of meat coming into May. The CCP is exerting military pressure on Taiwan and coursing its neighbors in the South China Sea. So we're seeing China really flex its muscles. Their main goal is to, number one, remain control of their population. If you think about it, it's about a few million people who really control China, and they're extremely rich. They're so rich that they can manipulate governments around the world, corporations around the world, as they tax a billion people at a 70% tax rate, and they're only making $3.50 an hour to sit there and build your iPhone. So it is a very dangerous foe because there's no single entity in the United States that's nearly as powerful as China as a whole. And so that really is China's strength. This is not recession data that's coming out. It's a full-blown depression. Now, obviously, they will swing higher once the lockdown ends. But even Merkel makes it very clear we can't know how bad this will get, and this will be very difficult for a good while. I think that the reopening of the economy is going to be much slower, one, and then two, it's really the Fed policy and quantitative easing that's given the bump in the market and nothing else. So we'll take a look at what the trend is for the Fed and why they really can't continue to do QE and sell massive amounts of treasuries, or at least support the treasury in doing this at the same time. And there's no coincidence that every single time the Fed drops rates to zero, we have a stock market crash and bond rally. And at the same time, the government puts the printing press to the limit by issuing new debt that it can't pay for with tax receipts. So this time will not be different. And data from major metropolitan areas show a spike in at-home deaths that suggests the true number is far higher than the official tallies. It's only unbelievable because people still underestimate how severe the impact of all of this is. Here's France's PMI. Well, let me get back to where we were. All the PMIs in Europe are around 30. 50% means you're growing. Going below 50 in the past would be a stock market crash right in itself, but right now there's still a bunch of funny money floating around. This is their services PMI, which is in the low 10s for all of the Eurozone, but their manufacturing PMI is in the 30s. The worse the real economic data gets, the more absurd stock valuations look. This continued fanatical attempt to save stocks against all reality is making a mockery of the global financial system. And I don't think the central banks are actually trying to save the stock market. I think they're trying to protect the credit markets, and we'll take a look at that later as well. Now we have states wanting bailouts for their pension funds, but McConnell says that this should be paid for and not debt financed. So that's the next round of bailouts outside of the oil sector. Art Berman, most producers didn't sell at negative spot prices. Spot price is an ask based on futures and an correction. That's not the point and not the price. Large producers have contracts with refineries that set monthly prices. Smaller producers often don't, so they put it in the tank. So he's just criticizing the way the oil market's financialized by the futures market. Okay, and we'll end with a propaganda quote out of CCP, Hu Hijin. Who knows why they get to have Twitter accounts to mock America while they ban it for the rest of China and don't allow our media in China whatsoever. But there you have it. Also, it's very curious that Facebook, YouTube, Twitter are all partnering up with the WHO, who clearly is motivated by China and has been really misquoting the truth this entire time. So that connection is very worrisome. The US can't produce face masks now, and its aircraft carriers can't move. All it's left is a big mouth politicians like you. What you're spewing out is just political virus that undermines global solidarity. Tell the world what contribution the US has made to humanity's virus fight. Okay, so we're seeing Pompeo come up and start to put on the heat, indicating that we do have turmoil ahead with China. All right, let me put up the pricing page. We'll take a quick break. I have a lot more content. We'll roll right to the boot camp and not even get close to all the content I have for you today. All right, Dean, you want to give them a walkthrough for our products and options?
All right, guys. All right, thank you, Jason. Appreciate it. Great presentation as always. So real quick, guys, couple, oops, there we go. Couple options on the screen here, guys, to think about. Number one is the buy and hold portfolio. Okay, this is great for investors that have less than 30,000 or 30,000 or less to invest. Okay, real simple. It's just going to use ETFs or inverse ETFs to be long or short asset classes. Okay, and we only made about 5 changes last year, and we made 5 changes to the portfolio this year. Not as involved, right? And we'll have a webinar every Monday. Now, on the basic portfolio option, it's going to be a little bit more sophisticated. It's great for investors. They're going to have between $30,000 and $75,000 to invest. Okay, you will need options to be able to follow this strategy. And if you don't understand options, that's totally okay, guys. You just need the approval to be able to replicate the options that Jason engineers. Okay, and you can utilize that to basically understand how to understand how to short the U.S. equity market to make just insane returns. Doing that, we're targeting between 5,000 and 5,000% on those put options. And then once we roll out of those put options, we'll tell you when to get back into the market, when to buy. Okay, once the blood is flooded on the streets. Okay, once again, basic is great for people that have 30 to 75K invested in the market. Okay, now the third option is the Pro portfolio. Okay, and in the Pro portfolio, guys, it's going to show you how to own probably the safest structure you could possibly have for today's day and age. Okay, we have a wonderful exposure to the bond market, to gold metal miners. Okay, and we just took a speculative position in USO. Okay, now all of the long trades that we have, right? So we're long bonds, long gold miners, and long US W2I. Okay, all of those positions have options protection underneath it at all times. Okay, and well, typically at all times. Every once in a while, if we have a really big move coming, we'll take the protection off here and there. Okay, but it's really neat, guys. That portfolio is profitable for the year. When you look around the globe, it's going to be really hard to find anyone, honestly, that can say that as well. So we're extremely proud about being able to say that. Extremely proud of the fact that our worst closed out monthly drawdown period was 1%. And the portfolio did well over 17% in return last year. So pretty neat, guys. And you know, if you have a significant amount of capital in the market, it's phenomenal to follow. Okay, and we have people using from 75K up to in excess of multi-million-dollar tranches behind that portfolio. Okay, and last but not least is the boot camp, and you're actually going to get the boot camp for life. Okay, and it's really cool because you're going to get an education first off and foremost on how the financial system works. Okay, that's the first video you're gonna go through and learn about. You're gonna learn about some bonus trades that are in there, sitting there waiting for you to go ahead and put on. Okay, and you're also going to slowly learn about options over the course of the system, really in depth, guys. Really, Jason's going to take it down to a granular level. Okay, truly explain everything A to Z, and also tell you what time, what the financial system and what the macro environment is handing you to then structure certain option strategies with. Okay, so it's really cool, and the whole focus there is to take you from kind of a novice to a professional. Okay, and even if you're already a professional trader, it will help you absolutely hone your skills. And I can't tell you how many professional traders I've met that still are clueless on how the financial system works. They've just, they've got decent at technical analysis. So there's some value there. And just want to point out, guys, if you join the basic or the pro portfolio, you will get 30 days of the boot camp at no cost whatsoever. Okay. So all I'll do, guys, is just post those links in there so you can go ahead and take advantage of those bonuses that are available for you today. And we look forward to showing you how to navigate these waters with the safest structure possible, and also how to massively profit from the upcoming crash in the stock market. So give me just 1 second, guys. I'm going to post those links in there, and then you guys will be good to go.
Excellent. Thank you, Dean.
All right. Thank you, Jason. Appreciate it, guys. Thank you for your time. And if you do have any questions before you get started, just give me a call, 505-322-7515. I'll do my best to get back to you as soon as I can, but do have a pretty busy schedule today. So thank you, folks. Appreciate your time. Look forward to helping you. Have a great day.
Very good. Thanks, guys. A news piece just hit a minute ago on my Bloomberg feed on my phone. Let's see if I can find this. Interesting data just came in. Let's see where I can find the breaking news. And let's take a quick break for some questions too about the trade alert. So for anybody who's an existing customer or a new trial, at this point, I do want to take a quick break and answer trade-related questions before we spend the rest of the hour jumping into charts and news. But the interesting data that just came out of New York is they found.
I think I just found that link for you, Jay. I posted it in the chat.
Nice. So this is the most important data that we don't have at our fingertips. And here we go. New York finds virus marker in 14%, suggesting widespread. This is based on 3,000 total people. So not really statistically powerful yet, but at least some data. And they were seeing in certain sectors that it was up to, so now they're jumping up to 21% testing positive. But if we go to the breakdown, it just doesn't add up to that. So according to New York City, had the highest rate of positive tests at 11.7, 16.7 in Long Island, and 3.6 for the rest of the state. And we got to remember that New York's really the epicenter, the worst place for all this, and that the rest of the United States is nowhere near as dense population, and as well as we haven't seen nearly as many mortalities there. So if we go to our metric here, I think we're still pretty dead on with that new piece of data once we look at each state individually. But if we did look at the population of New York, we could target this in, but we'd have to look up those exact deaths in New York. So anyway, I do think that our range is quite accurate, and that, again, we're really on top of being able to see the progress of this and predict what's going to happen before it does happen, which has been critical to predicting the markets this year. And again, I don't, before this year, I was the guy who didn't wash his hands always, would eat food off the ground, and thought that, because I'm so healthy, I don't have to worry about anything and I'm never sick and yada, yada, yada. But now I've had to deep dive into what this all is. Pat says, I think it's already over. Most public pension funds are underfunded by greater than 40%. Pensions can't take a third recession in 20 years. My prediction is you'll see states file for bankruptcy and pension members will take a 50% cut in distribution. Yeah, that's a huge nightmare that's been sitting in front of everybody for decades, Pat. Good point. And Pat's been helping out doing extra research for us on the antibody testing. So you know what, Pat, if you did want to really deep dive into that information I just posted, that would be great. And it's always great to have. Oh, Karen says my fear as well as the pension. Okay, great, Pat. So yeah, so that data is brand spanking new. It's only on 3,000 people. All right, let's jump into some more content. Henry has his hand raised. Let's go ahead and unmute Henry. Anybody else want to have a question? Now, I do want to say, we don't have time for commentary today, but if you have a question, I'd love to answer any questions right now. And we'll start with Henry. And if anyone else would like to speak, please raise your hand and unmute your mic or post a question in the chat box so we can review the current allocation of our portfolio. And if we don't have questions, we will jump right into content. Okay, Henry, you have your hand raised, but you do have to unmute your mic. I'll go ahead and continue until I do have a question pop up. Okay, let's take a look at Ram. Go ahead.
Hey, Jason. So if we sign up today for the Pro, do you suggest, when do you suggest getting the GDX?
Today, I would buy the put option today, the 28 strike put, and I would hold off a little bit on buying GDX. And let me just show you why. So, you know, a lot of people love them some gold. Okay, they love them some gold, and they tend to think that it's something you want to buy to protect yourself against a stock crash. So that is something that's quite easy to show investors is not a good thing to think is true. Okay, so let's just take a look at the 2008 crisis, and I'll show you why, despite it shooting up and being one of our most profitable positions as of currently, although the TLT's been behaving very beautifully as well, despite the market going up. Usually if the stock market goes up, TLT tanks. And because TLT's been going up with the stock market, you know that the stock market rally is a dead cat bounce. But this is what I want to bring your attention to right here. Look at the strong correlation to stocks and gold. So stocks and gold both do well in an inflationary environment. So that means you have expensive oil, you have red hot employment, and you have growth of debt. So you have inflation. But when you get a deflationary hit, look what happens. And so we have the SPY against the spot gold right here. So I believe what makes more sense right now is to not chase the runaway spot gold or gold miner price. Buy that put, be patient, and then perhaps we'll have an opportunity to buy it on a sharp decline, which I do highly believe is coming very soon. So the gold market did decently in terms of less loss than the 2008 stock. Let's look at from the high. So here's where the stock market sold off in 2008. Mm-hmm. And you can see right out the gate, gold did okay. But as the US stock market continued to decline, it did not perform. Okay, so we can see right here how correlated they were into the sell-off. Now, here's the catch. In the 2008 crisis, it was $300 billion of bad loans. Okay, they turned those into derivative products that represented $3 trillion. Go ahead and unmute Mark too, Ryan, please, if Mark wants to get a question in there. So they did rate cuts first. They waited a year, then they did QE. And so the argument to be long gold today is that we are seeing quantitative easing, at least in the last few weeks. At the same time, they've done rate cuts, or at least back to back. So they did rate cuts, and then rather than waiting for the crisis to be resolved, they jumped into QE immediately. And so we can look at why. But that's why at this point in time, I would only pick up the put and then sit back and wait for a alert to pick up those stocks if you're brand new. If you're an existing member, then we have a strategy that involves trying to get to the 1 year mark and holding our position so that we can have a lower tax rate and rotate into silver, which we'll look at in a moment. Mark, go ahead. And Ram, we'll come right back to you to make sure all your questions are answered, but I'll pull up the trade doc again.
Yeah, I don't know if you saw, but the market did quite a bit of a tumble at 11:45 because the WHO accidentally released the remdesivir study that was done in China and basically characterized it as not a helpful medicine whatsoever. And then they realized their oops and removed it, but not before the world saw it.
Oh,
so
boy.
Just more BS between China and the WHO.
Yeah, and now you have Facebook's legal advisor saying that if you say anything that goes against what the WHO has said, you're banned or your content's blocked. And Google's doing the same thing as well.
Why is WHO protected?
Yeah, so WHO is corrupted. And
now gold is suddenly tumbling. I don't know what's up.
Well, gold's correlated to stocks. So Ram, if you're just starting to follow, I would just wait. I think I can get you a better entry point. So that's why I wrote hold, but do not buy. But the put, I like buying today. So we realize we want to have that put when we own the shares. Today, I think it's a cheap price for the put. And I do see trouble ahead. Now, let me tell you guys why I think we're nearing the top of the market. And this is really the biggest driver of the markets right now. Okay, and again, usually they don't do this. So I do think this was a one-shot injection to protect the credit markets, not the stock market, as everybody likes to quote. So here's the Fed's balance sheet. This is how they expand the money supply. And to simplify your life, this right here shows you the average change week over week. So if we go back to March 5th, they added $25 billion to their balance sheet. If we go to March 12th, they added $77 billion. Wasn't enough. Go to March 19th, they added $240 billion. They were getting close to enough to stabilize the credit markets. They got to $506 billion by March 26th. Stabilization was nearing. April 2nd, they did $605 billion. And again, this is where the Fed buys treasuries and mortgage-backed securities. That's primarily what they've been purchasing. Stabilization achieved, and this is where we got the big rally. But once the credit markets were secured, they've been dramatically reducing the size of QE. So they went from 600 billion to 393 billion, so a reduction of about 33% or a third. Then in the recent print, they went down to 228 billion. So that's almost a 50% crash in quantitative easing.
Is that each week or is that total?
Per week, yeah, that's how much money they're diluting your dollar per week. So that's very bullish. That's inflationary, so that's good for stocks. It's good for gold. But every Friday, they do tell us what their plan is for how much treasuries they'll buy. And so this week, they told us 25 billion a day. So add in whatever they're going to buy in mortgage-backed securities, which clearly are in huge trouble because no one's paying rent. So I'd expect that this week we'll see a print around, I'm going to guess, $150 billion. And again, this print will come out at sometime after the close today. George says, when should I sell GDX? We're not going to sell GDX this year, George. We're going to sell our put option and remain long. There's a big tax benefit to hold your position for a year. So I like to actually get into an asset, even if I think there's downside risk ahead, if I want to be ahead of the curve. And we'll take a look at the history of what gold miners and silver do against gold in the stock market in a second. So you can see exactly the opportunity I see coming our way. But if you're just getting started, so George, what am I going to do for those of you who do have the position and you're up a lot? Well, guess what? We're going to buy another put to protect and lock in those profits. And that allows us to buy and hold and not have to, A, realize a profit at a high tax rate today, and then B, we want to, again, hold that for a year so that next year we can start rotating out of GDX at a low income, at the lower tax bracket, so the long-term gain, and then rotate into silver, which tends to outperform gold, but not until gold has really started to rocket higher. And again, with the deflationary force coming our way, I do see trouble ahead for stocks, surely. And as I'll show you, the gold market's highly tied to the stock market. So this Thursday, again today, I'd expect this to drop to, depending on what they've done with mortgage securities, as low as 125 billion. We know it's going to be 125 billion minimum in terms of treasury purchases, because that's what they said they would do last week. Now this Friday, they will likely tell us, as they have been every Friday, what their intentions are for the coming week. And I would expect that to continue to drop lower and lower, which is exactly what they need to do to allow the government to sell $2.6 trillion of new stimulus money they've promised. And at the same time, the magnitude of the deficit this year is going to be just incredibly, incredibly massive. So we went from $1 trillion deficit last year. They had $1 trillion, $1.1 trillion deficit plus, maybe more like 1.5 trillion before this chaos ensued. So that was assuming healthy tax receipts and all that jazz. But now they've thrown another $2.6 trillion to the tab. And at the same time, tax receipts are collapsing. So the deficit's going to be unbearable, and it has to be sold. That's really the primary trigger to crash the stock market, is that the government's going to hog all the resources of the economy. And typically, we like to go stir up trouble around the globe to help force more money into our debt issuance. So we'll take a closer look at that. But this is the main thing to watch, the biggest central bank. Now, can Bank of Japan come in there and do some QE and delay this? Sure. That's something we have to keep close eye on. But right now, they would have to first come out with greater fiscal spending to increase their bond purchases, because they're already maxing that out. Didi says, do you think USO has turned up now? Bottom is in. I'm not sure about that. So we'll take a look at USO too. Okay, let me get cranking here because we're already running out of time. Okay, so I'm going to go ahead and do a quick review of all our positions, the key charts, and try to get us out with 5 minutes to spare before our boot camp lesson starts. Okay, guys? So let's just go through each position one by one and look at the analysis. Okay, so first position is TLT. If you believe that the deficit's going to grow at an accelerating pace, you want to own bonds. U.S. Treasury bonds, the 30 years, the most leveraged product with the most room ahead. So clearly the debt level is coming in an accelerating pace. The best analogy for understanding acceleration of debt versus just steady debt, think of a ride in a train. The train could be hauling ass 100 miles per hour, but if it's going the same speed, it feels like you're staying still. So that's not the kind of debt expansion we're looking for to be along the TLT. We want the kind of debt expansion that's more like going from 0 to 60 in a car and feeling your back getting smushed into the back of the seat. So we want the rate of change to be accelerating, not flat. Okay, so flat debt growth at a large scale is actually very good for the stock market. It's when you accelerate the debt. And this is the fastest acceleration of debt we've ever seen in the history of the United States. And I would say probably the history of the world. But my history only goes back a couple hundred years, so I won't promise that. But certainly for the United States, this is by far the fastest growth of debt we've ever seen, period. And so the tab's not even in yet. They haven't even started to sell the debt. All they've done is print a trillion T-bills, buy them up at the Treasury, and then hand it to, or they bought them up at the Fed, which is why the balance sheet has expanded so rapidly. And now the Treasury has $1 trillion magically in its coffer that came from nowhere. Okay, so that debt has to actually be sold into the bond market, and that's when you're going to see massive pressure in stocks. So let's pull up some charts and look at TLT really quick and some comparisons.
Jason, if you don't mind, can you go through the list of what we're gonna do? Like if we are gonna join today,
Sure.
what are we gonna buy?
Yeah. So if it says buy and hold, you buy it. If it says hold, do not buy, you don't. So let's walk through that. So TLT is buy. This is my favorite position, and I believe this will be a multi-year play. GDX has gone up a lot, so I would just wait to buy that. I'm not the kind of guy who likes to chase a momentum play. I know the TLT's at nearly at all-time highs and looks like momentum play, but the fundamentals for TLT are lining up beautifully. Gold, again, is super correlated to the stock market, so is crypto. So unless there's a rare disallocation of their correlation, I'd expect some serious downside ahead for both gold market as well as Bitcoin and silver and things like that. So rather than sell our GDX, I'll quite likely tap off our put options on the SPY and GDX at the same time. And I think that'll be not this Friday, but next Friday. I want to see the Fed, again, show proof that they are slowing down QE at a rapid pace to signal that we're going to switch gears from protecting the credit market to growing the credit market. The only way they can grow the credit market is stop doing quantitative easing, which forces everybody to buy and hold the debt until the problem has been resolved. Okay, let's go on. So USO, I love this play. DD asked, do I think the bottom's in? I don't know. I know there's a lot of problems for the oil market. Let me pull up the chart on that in a moment. The way you play this trade, you have very, very little to lose because you have the married put. And again, our hope is for the administration to come in and basically pay miners to stop drilling, not miners, drillers, and to buy a lot of US oil. Gary says, why do you think metals will go down? Because we have a deflationary force coming our way, and that's very bad for both stocks and gold. And I can show you proof with the charts in a moment that there's almost no case study in history where you can be long gold and do well when there's deflationary forces and stock market crashes. Yep. So it's if you think you have a slowdown in your economy, then you want to be long bonds. If you think that you're going to have inflationary problems, you want to be long gold. And we can talk about why. But inflation causes the Fed to hike interest rates, which crashes stocks and bonds at the same time. And they've only done that rarely through history because it wrecks financial markets. It's really their last ditch effort that they hate to do. And I do see that coming down the pipeline, but probably not for quite some time, 3 to 5 years. So we'll take a look at that. These are all a buy. These are your downside protections against the stock market selling off, and will give us the confidence to rotate into the critical ETFs that, again, are going to get the government money. So we're just following the money. Step one, the government has to pass all the bills. That's been accomplished. So they've promised no less than $2.6 trillion, and probably by the end of this year, it'll be upwards of $5 trillion. Okay, so that's step one. To shortcut it, they did T-bill issuance, which the central bank bought up, but those roll over every week. So they're not going to keep that on the weekly basis for much longer. Okay, so that's accomplished. So first we predicted that they would do these massive bills. Now remember, when this first broke out, they're throwing out $8 billion fund to solve this. And I was like, no way, this is going to cost trillions. And sure enough, now today we have 2.6 trillion promised, and that number keeps going higher every single day. So that was a good prediction and very good for the bond market. And again, it's like a steroid shot for a cancer patient. It might make you feel better for a week, but it's not going to cure the underlying disease, and neither will stimulus for the stock market. So these are very good put options at today's price. And again, I will quite likely tap this off after I've seen the Fed really confirm the end of quantitative easing, which really marks the beginning of expansion of credit, which is, again, good for the bond market, bad for stocks. So GDX, I may add yet another put to protect the gains we've had on that. And then for those of you who want to get into gold, we'll be only recommending that put. Okay, so that's your current recommendation. 4 puts, and this would give you the downside protection to jump into GDX again as it's pulling back. So you'll be able to buy 400 shares and do it with confidence because you're owning the 28 put. The USO trade is still a great trade today. It's 2,000 shares of USO, but protected by 20 put options that are, let's see, where's USO at right now? Just 20 cents under the current trading price of 267. So you're only going to have 17 cents of risk plus the cost of your put to put this position on. And our target is for a quick pop on USO to the probably around $8 is where I think we could see a good hit. And then I'll be tempted to liquidate that full position. Now this is playing the futures market, so we do not have to get a 1-year hold time. It's already quite tax optimized. So you get the 60% lower tax rate on 60% of your profits, and then 40% as a short term. Okay, so that's the positioning we have currently. The last position that's still a buy is the 31 strike November 20th FXI put, and that's 10 contracts per 75,000. So is that pretty clear around what to buy and what not to buy? So anything that's not a buy currently, it says hold, do not buy today. So hold means just hang on, don't do anything. Okay, so I'm going to jump to some charts and go through as much as I can before we go into our webinar. Okay, so gold looks really hot. So does the stock market, but our analysis tells us that that's a very foolish trade right now that's only been stimulated by a quick push of QE. And we do believe that QE is coming to an end, and that really what we want to do is be long the bond market. And so seeing stocks go up some 20% in the last month, and the treasury market just stayed steady and actually rose, is really your giveaway that the stock market is only going up because of the increase in liquidity and not because of any fundamental reason. Which means the second the free money dries up, the momentum's gone and everybody turns into a seller. In fact, 8 of the last 9 days, the big hedge funds were selling, not buying this rally. Okay, so here's gold and the SPY 2008. Okay, you can see they're correlated. They crash together. They go up together. The key thing for the stock market is quantitative easing. But the game plan for quantitative easing is first you sell the debt and make the big banks hold it. Fix the reason that you made the debt issuance in the first place. So anytime there's a crisis, that's when the government comes in with these big stimulus plans to fix a problem. Okay, they don't do these massive spending problems unless there's a huge crisis. And so that's why every time we've seen a crisis, TLT goes up, stock market goes down, rates go to zero, QE comes in at the end after the economic loss has been absorbed. So this time around is at least 10 times worse than 2008. And that's why they did a quick shoot of about $2 trillion in QE in a month. So you got a bit of a bounce, but now they're signaling that that's over. And again, they have to do that if they want to reward all the people buying bonds. If they keep doing QE, the bond market will stay flat and the stock market will keep rallying despite a third of the population being unemployed and deficits exploding. So there's just very little chance of that. And in fact, if they kept doing QE, it could actually backfire and cause the bond market to sell off, which would create that spike in yields. Once again, another problem for stocks. Okay, so we can go look through history, and there's just very few. There's cases where the stock market goes up and gold goes down, but there's very few arguments that gold can go up while stocks are going down. And so we can see as I go through the timeline that they are quite correlated. Now, just like in the 2008 crisis, we have seen early on a mini crash in the stock market that gold does have a knee-jerk reaction. But what comes next is they do tend to crash down together. So let's look at the actual play we're in. So the previous slide I like to say is comparing apples to oranges. This is going to be more like comparing apples to apples, just different colored apples. So we have spot gold, GDX, and spot silver. Let's go back to the most recent crisis, 2008. Okay, so here's where the stock market sold off, and we can see gold did the best at maintaining value relative to its peers, but it still went down, not up. And at the bottom of the crash, which we can put right here, gold miners outperformed everyone for about 2 years. So after 2 years of quantitative easing, there's this rare point in time where silver started to outperform. Okay, and I know a lot of people got very wealthy on this run up in silver. So that is the same trend I believe will play out. It's the biggest market goes up first. That's spot gold. That's about a $10 trillion market. Then you get the second largest market tied to that to go up, which are the gold miners, creating the supply of gold. And then after those get too expensive, money rotates into the very, very speculative market, silver. Okay, so that's my predictions for the gold market. Is it's going to go down as stocks go down, and then we'll want to be long gold miners, not gold, and then long spot silver, not silver miners for the last leg. And then I'd expect that we're going to have inflationary problems that put everything to an end quite quickly. Okay, so that's a quick view of gold market. Let's look at the oil market. Okay, so USO is our play. A lot of people don't understand what the heck USO is. It's not what you would think. So here's your chart of USO. It's at very depressed levels. My target to get out is probably around 8. So very huge profit opportunity. Most of our members got in at 380 on Monday. A lot of you got in at 250 yesterday. Get in at 266 today. The same shares are recommended, 2,000 shares per 75K. And what we're looking for is a quick spike, and then I think this will continue to crash for a lot longer. So let's take a look at the analysis. So USO is a futures play where you want the red line to be trading above the black line. And so that means the short-term price of oil is rising while the long-term outlook is flat or down. Okay, so that's really the play here. Now, if we go back through history, we can see that the price discrepancy is quite tight. It's still making the price go up and down, but the 2 months apart in WTI are quite close. And there's a few little discrepancies where they break paths, which right here is what we're looking for. See in December where the red line went above black, and that drags the black line up. That's the trend we're looking for. But suddenly, when the oil crash began, we had a problem with storage. We don't know where to put all the WTI, and that caused it to go negative for a short minute. So what do I think is going to happen for this to make money? Well, my hope is that the long-term outlook for oil remains bleak. Okay, and we got Saudi Arabia flooding the world market to achieve that. So mission accomplished with that. Right now we have 50 million barrels coming our way from Saudi Arabia. They've got even more going to Asia. They're sending it everywhere. They're desperate to sell it as they battle this out with other oil producers in the Middle East and in Asia. So also interesting, they potentially knew about what was going on when they did their Aramco IPO to raise a bunch of money, which I believe is helping them finance this war. So what has to happen first to make money? To make it really simple, the long-term outlook for oil, we want to be bleak. Okay, and that is there. The hope is that the short-term immediate outlook has a change of sentiment that pushes the front month of WTI up. So right now you can see there's a discrepancy of about $6 between the front month and the second month of the futures contract for WTI. So what's the catalyst that gives us that? Well, I think the black line will keep tanking because of what Saudi Arabia is doing, but I believe the red line is going to go up because what Saudi Arabia is doing is going to potentially create a spike in the front month. So what can happen? Well, oil companies stop drilling. Okay, we just saw Kuwait starting to do that. Any small oil driller is going to lose money at these prices and go out of business. So that's going to create a spike. But the big move will be the administration paying U.S. oil drillers to stop for a few months, and at the same time, they buy a ton of U.S. oil. Okay, so if that happens, the price could spike significantly, and that's where we get the big hit on USO. So again, my target is to get out of Dodge around probably around $8 a share, because I do think this is short-lived, and potentially we go back to even lower lows overall in the oil market. Although I think the next big play to focus in on may not be this breaking path. So once the administration comes in here and manipulates this, this opportunity is probably long gone. So I love this play. And Edward says, what will be the target for USO after it splits? So they're going to make the price increase eightfold on the 28th. So Tuesday, there's a 8-to-1 split. So for every 8 shares, you'll have 1. That'll increase your price. So it'd be 64, I believe, Edgar. I'll double check that. So 8 times 8 to get to 64. So it doesn't change your profit loss or anything like that. They're just doing it so it doesn't look like a penny stock in case this keeps going lower. So all about mentality with that. So yeah, I think this may be a one and done opportunity. And then the big opportunity after that will be to wait until late this summer to buy Brent oil with some sort of play like that. So I'll be keeping a close eye. But yeah, the pain in oil market is going to be very correlated to the pain in the stock market. So this is really a manipulation I'm expecting at the government level based on all the bailouts they're currently doing that will really benefit this trade. Okay, so let's see what we can get to next. And we can always turn on the boot camp webinar a few minutes late if this runs over a bit. Okay, so there's your oil play, what has to happen. And again, it's a very odd product. This is a huge opportunity. Really excited about this play. And timing, yeah, I think they have to fix this relatively quickly. So I'd expect to see intervention at government level within the next 30 days. And if not, if they don't save this product, then what's the risk? Well, USO goes to 0 if those 2 future contracts drop below 0 at the same time. I don't think that's going to happen. I think the government's going to have to step in and intervene. And that could be one last little bull pump or at least one thing to keep the market in this 280 to 290 level on the S&P 500. Another cheerleading event that, hey, we protected the oil market in the U.S. It's critical we protect our energy independence. So that means they have to bail out the oil miners. And the strategy to do that is to get the price of WTI up. And they could do that by paying them to stop drilling and then simultaneously go do an infrastructure build out to store a ton of oil and just gobble up all the cheap oil on the market, which again creates a deflationary benefit for the United States for who knows how long, depending on how much oil we buy. So another reason not to be betting big on gold right now. Okay, so that covers USO. Any questions on that? And again, I do think this will be a quick hit. That'll be awfully expensive for them to keep at that pace. So I think we'll see it pop up and then gradually start to sell off again. So we do want to get in and out on that one. The bigger play would be on the Brent oil, but again, this could go much lower. So I'd expect a little pop from the same reason, and then again, another big push much lower. As long as the Saudis are flooding the market and PMIs are in the 30s, we can expect that the demand for oil is going to be troublesome until many go out of business. So until we have lots of companies go out of business, stock market hits a bottom, and we've got people back to work, the value of oil has to go through some pain in terms of taking out the weak hands. Okay, there's your gold rally. Again, I'm expecting central banks to dump gold and force people into bonds and use the media to push stocks. There's no benefit to the crisis if everybody gets rich from gold, so they can easily manipulate that market. They're well known to do it. I bet they let it run hot a little longer, attract all the momentum gold bugs who think this is the new breakout, and then dump it hard. So I'd be very cautious with that when we look at the deflationary pressures and the cheap oil. Take a look at the currency markets. Here's your dollar index. Okay, a dollar over 98 was my line in the sand in January to know that things were not good in China. Also, we saw their market selling off, and then we found out why later. And there you go, your dollar index continues to climb despite us essentially making it absolutely free for something like 13 central banks to exchange their currency for our currency. So just the pressure to have dollars is tremendous. And if you have to make a decision to fund your business or your bank to have dollars in its banking system, you have really two choices. You're going to sell your U.S. Treasury, or you're going to sell your U.S. stock. Well, I think the Treasury market looks much safer. So I would sell my stock that went up 20% in a month to fund my dollar needs, especially when I know the dollar is so strong right now. So strong dollar is also telling us we have the perfect setup currently. Okay, here's some other currencies against the dollar. Let's see what we have strengthening. The Aussie dollar is having a little strength, but remember this was down tremendously in a longer time period. The big trend here is that all the currencies are losing value against the dollar over the course of time. And that's because all the debts of the world primarily are denominated in dollars. So they're constantly paying that interest in dollars, and at the same time printing their own currency and converting that into dollars, which further weakens their currency. So let's see, the Japanese safe haven yen is selling off from their note that they're going to do unlimited bond purchases. CNY, the Chinese currencies, losing value. All of them are losing value currently against the dollar. Okay, let's go to next chart. And also the print on inflation was 1.5 for March, so super low, and that could go to negative territory. Gary Barber has a question. Go ahead, Gary.
Sorry about that. Can you answer me a question about the USO position?
Yes, sir.
Okay, I'm just a little bit confused about it. I have, let's see, 4,000 shares of USO.
Okay.
And I have 40 $4 puts. Right?
Yep.
Okay. And I can't figure out why my USO position is down much more than my puts are up.
Yeah. So,
I mean, is it, am I right?
yeah. So let's think about the value of the put. So really the value of the put is twofold. So one, it's in the money. So we can hold that to expiration and get the full value of it. Or two, if it goes to zero, you get the full value of it.
Okay.
Okay. So I wouldn't worry about that discrepancy.
All right. I just want to make sure I did this right because I have a habit of moving decimal points.
It's not protecting it 100%
okay.
right now, but at the expiration date it would.
Okay, good enough.
To zero. Yeah.
All right. Thanks a lot.
You're very welcome. Ron, go ahead. Karen, go ahead.
Hey, Jason. I know you didn't recommend this, but I'm in an IRA and I don't really need to hold it for the GDX for a year. Would you recommend, or would you be okay with selling the GDX and keeping the put?
So I would look for the next put I put on as a sell signal. Perfect. So the same thing for the TLT. If you see me buy an at the money put, that's really for the cash accounts who need to try to avoid taxes, allowing them to hold. So yeah, absolutely. If you want to just dump it. But remember, the married put strategy has some advantages. If I'm wrong, then all we got to do is pay off that put and we generate a safe profit.
So best way is just to wait for you to put on a new position.
That's what I would do. Yeah.
Okay. Thank you.
Because right now, I've been saying, hey, we got downside ahead for 4 weeks now, and GDX keeps climbing, right?
Right.
So the married put does have some interesting advantages as well.
Right.
Good question.
Okay.
Karen, go ahead.
Yeah, I was just trying to figure out. I'm trying to get my my thinking correct on this reverse split thing, the 8 for 1, 1 for 8, however they're doing it. Now, how does that happen? For instance, with your options? Well, really, the whole position on USO. If you've got an even, you don't have a multiple of 8. How do they do that?
So they're going to give you some cash back where it doesn't work out. And then on the options, we'll see what exactly they do. But when that shift happens on Tuesday, we will adjust to make sure we have the right protection. It should be pretty close. We might have to buy or sell a put.
Okay, because that's what I was concerned about. If it was something that I should address before they do it, so that I don't get caught in some strange adjustment that they do, to my deficit versus to my benefit. So that's what I was trying to. I just couldn't figure it out. Okay.
Yeah, I'll read through the details of how they do that accounting. And we'll be prepared for Tuesday when that occurs.
Okay, very good.
And our inverse ETFs had some splits too, so I have to fix that in the buy and hold.
Okay, thanks.
Good question. Oh boy, it's crazy how fast 2 hours goes, huh, guys? Well, let's see. I'm going to take a few last questions, and then we're going to take a 5-minute break, and we'll launch the bootcamp webinar back to back after this. So let's go ahead and apologize, especially once we have all our economic slides in here. We're going to have probably be able to easily fill 4 hours a day. Yesterday we went 5 hours. That was really fun. Had a great time with everybody. And yeah, we're not even touching the news, and there's just so much content to cover to keep everybody informed. Last questions before we take a 5-minute break, and then I'll launch the bootcamp webinar. And again, the goal of today's bootcamp, we'll review the trade alerts I still recommend for the bootcamp, and then we will also build out a spreadsheet Murray says, if GDX is expected down, why hold so much unless for a longer term gain and tax reasons? Right, so that's the core reason to do that. So if, again, the same question that Ron had, but remember the married put has some advantages. Primarily, if I'm wrong on the direction of GDX, you still make money. If I'm right, you protect the profit we've had so far. So that's one reason. And then two is, again, if you can cut your tax obligation in half, that makes a lot of sense. Now, I know a lot of you are trading in tax deferred accounts. So I do have to keep that into account. But yeah, we keep buying at the money puts and we keep paying them off, and GDX keeps going much higher. So the timing of all this really relies on the central banks going from, okay, we got to keep the credit market from imploding on itself, which is what we saw in March. Credit market should have been going up as the stock market was crashing, but it was crashing at such a fast pace that central banks, major primary dealers, and huge hedge funds like Ray Dalio had to not sell what they wanted to sell. They ended up selling what they could sell to cover all the losses and try to protect their huge equity positions. So the Fed made what I believe is a one-time exception to the game plan to get the credit markets back in track before they went to expand the size of the credit market. And so the credit markets are going to dramatically grow in the coming months and years. And so I believe the QE that we've experienced was not to protect stocks, not to rally gold. It was indeed to protect the banks, who are the big bag holders of credit. So the Fed's main interest is protecting credit, not stocks. And the problem is, if stocks crash too far, the big banks have to sell their credit products to cover. And so that's why we saw that huge injection of capital. So yeah, the married put has some advantages. The implied volatility on GDX has gone down. So we're going to get a cheap put. And if it keeps going crazy, if it breaks paths of the SP 500, if all the big players ignore the correlation of GDX to the overall market, they forget about the year or two of deflation ahead, and they just start piling into gold miners because they know that's a very lucrative business in the long run. Well, then the married put strategy has some big benefits. We just pay off those puts with appreciation in the underlying, and we don't care about losing money on our puts. Now, on the other hand, if it does maintain that correlation, we've essentially locked in the profit outside of the cost of the put, and we'll sell those puts when we think we're near a bottom in the sell-off in stocks. So it allows me to be incorrect, and you still make money. If I'm correct, you're going to make more, but if I'm incorrect, you still do well. It's also a hedge that if they just keep doing QE longer than I expect, that gold miners are greatly outperforming stocks. So we've already got our cash pretty well allocated, but I can't tell you how often I've been tempted to increase that GDX position as a hedge because I love the fundamentals of gold miners when I do look further down the line. The only thing I don't like about it is the deflationary pressure and its correlation to the stock market. Go ahead, Kathy.
Unmute. Okay. If we added 40 shares for every 1,000 we had of USO, it would divide evenly into 130. Would that be something you might consider us doing so we don't end up with this off stuff and cash back?
Let me go through the details of how that works and do the calculation, and I'll have that ready for us by tomorrow so that we can optimize the portfolio. Let's say Monday. Here's my promise to you guys. We'll optimize the portfolio Monday for USO so that we don't have to worry about it on Tuesday when the split happens.
Thank you.
And great suggestion by both of you, Kathy and Karen, on that. So good concern taken, and we will deliver. See, any more questions out there? Here's the inflation crashing. So that's bad. Let's just look real quick. We'll just end with this. When have we had deflation? I'm going to tell you it's really bad periods of life. So we know The Great Gatsby. I was trying to get my kid to read it. He's only 12. He just said he didn't get it. But here you go. So roaring 20s, and then we lead into the Great Depression. And here's that low inflation turning negative and then going super negative. And so the problem is, if you think you could buy a house in a year or two for cheaper, which if no one's paying rent, probably the case, right? You're not going to go buy a house today. One of my news articles was actually looking at the huge drop in mortgage applications and house purchases. So we're heading towards just a no-brainer. Everybody's unemployed. Cost of labor is getting more expensive, especially with all the free, you make more money not working today than you do getting a job. So the cost of labor is going to go up. Prices are going to go up. Profit margins go down, but the spending capacity of the population is going to be dramatically less. So not only are the prices going to look high, you have less money to spend, and that's how you get a Great Depression. You get this multi-year deflationary push. So it'd be interesting. I'll try to get a 100-year chart of gold so we can see how it performed in that period, but I'm gonna guess not super well. And also, this is where they started doing some crazy manipulation in the gold market. We could spend a whole couple hours just looking at FDR and all that interesting story. All right, guys, any last questions before I let us go for today? And then again, there's really two scary moments I see coming our way. First is this deflationary crash that could be perhaps 1 to 2 years based on hoping we get a vaccine. But then with all the stimulus we're creating, I'd be fearful we then enter a 1970 inflationary period. So in a deflationary period, you can get awful rich in the bond market. But in an inflationary period, bond market and stock market both get crushed. And I would suspect that's where you get your huge opportunity in gold and cryptocurrencies and things like that. So this is going to be a tough couple years coming at investors. And really, we've never seen that kind of a 1-2 combo punch. We've really seen one or the other, but not a push of this magnitude in both directions at the same time. I guess the only thing close to that was World War I. If we go back to World War I, we can see this deflationary print for a short minute, but it was first inflationary before that. So I guess the exact opposite. Okay, guys, very good. Any last questions? I'm gonna go ahead and take a short 5-minute break, and then I'll launch our bootcamp module. And our goal is to cover the 2 trade alerts I would buy today, which will be shorting the stock market and the Hong Kong dollar. I'm gonna go ahead and say pause on the silver trade, although I'm not recommending we sell that. We're doing well on that one. And again, we could buy a little protection for that one if we think necessary next week. Okay, thanks guys. We'll see you in a few minutes on the next bootcamp.